To the Kirkland Income Fund quarterly update. We're going to walk through a number of different things that occurred at the end of the year and a number of aspects that have presented themselves in Q1 and into Q2. Before we get started, though, we always have our standard disclaimers. We ask that, some of the information that we do provide is proprietary. So if you could not, share certain information with other people that are not investors. I'm not going to read through all that. You guys have seen those disclaimers before. We'll make this deck available for people, in the future. But let's. I
always feel these are a speed reading test, Chris.
Oh yeah, no, that's. I'll leave that up to other people. Read enough of those things.
Yeah.
No, let's just dive right in.
All right, sounds good, Chris. Here we go to the next slide. Let you cue this one up.
Yeah, let's. This is sort of a marketplace update. A lot of positive macro forces behind what we're doing here. There's still lots of money looking for yield. I can't talk to an RIA or a family office without hearing how they're worried about their fixed income portfolio. That is exactly one of the core reasons we started this fund, was to take advantage of what was already occurring for a number of years. And, thanks to COVID, we don't get to say thank you for much with regards to COVID, but with this one, they drove rates to zero and really brought to light what this fund is bringing to the investors. So that is going to be something that is going to continue for some time. This morning, I was just on the phone with Morgan Stanley. They have a presentation they're going to share with me about their outlook of what they think interest rates and fixed income alternatives are going to be a necessity for investors' portfolios. So I look forward to seeing that. We also are constantly networking with banks because, as you know, they are our source of exit out of our loans. And it amazes me to this day. I know this has gone on again for decades, since 09 and 10. They have tons of money. They have no idea where they're going to deploy it to. That makes me actually happy because they'll be ready to take our loans out and they'll be hungry for that business. So there again, what created this investment opportunity and outsized returns does not look like the banking industry is going to be coming back into being any form of competition anytime soon. Single family, lending business is crowded. We were talking to a number of different funds that specialize in the single family residence space development. They're seeing that on the bigger end, they're raising more money. At the top end, the big mega funds, the guys that are 800 million, billion plus, and they're now long cash. They have no place to put that. We'll leave names out of it. I never like to mention anyone's name, but a multitude of funds that I have connections with are long anywhere 20 to 25% cash, looking for homes. And oddly enough, we've had some phone calls from some of those people to come in and say, hey, how do we think about bridge financing? And I think it's very humorous that $1 billion fund would be calling me to ask questions about bridge financing when we're only, still managing roughly about 4 million. The rest of this update's all Brock. Why don't you take away some?
I'll say something about the single family too, just from some admittedly anecdotal observations as I talk to a lot of people out there. Is the other challenges, of course, are, and it continues to be the space here where in the construction area where we're not active, but one of the issues with the fix and flip and all these is just simply there's nothing for sale out there. So you've got a huge problem if you're a lender that's in the fix and flip space that's funding those type of deals, or any kind of single family construction. Well, you're really limited by just the simple fact that there's not a lot for sale out there. And number two, even if you get something in there, you've got problems with the huge rise in cost around materials. So materials costs for construction have gone up exponentially, and then even finding people to do the work. So those are two areas where it's really tough for these folks in the single family bridge loan, hard money, fix and flip space.
Yeah, the duration of their trade definitely has extended, and a lot of that is due to the inability to get timely construction and complete projects. So,
right. For us, so down here, the sub $1 million loan space it's really still very uncrowded. I talk to brokers on a daily basis, and I talk to new brokers all the time as we're expanding our network of loan brokers, that commercial loan brokers that are really working in this space. And the story over and over again is, wow, I'm really glad that you guys are out there, because previously I had no one to send these deals to. And this is particularly the case for sub 500 stuff. You can still find a few lenders who will make exceptions in certain states, certainly not nationwide, who will go into, we'll do a one-off at a 750 or higher. But really, you start not seeing hardly anybody going below 750 and certainly not 500. Yet there is a tremendous amount of great commercial deals, particularly multifamily stuff or mixed use, where we're seeing where maybe the purchase price is right around 500. Well, you're not going to do a over 750 or over 500 loan, of course, with that. So we're picking up that, and that's where we can get that outsized yield that then we pass that on to you. So they're happy to know we exist. We aren't seeing much price pressure on that, because simply, of course, these are deals that the banks can't take because of maybe vacancy factors or other issues with the property, or they just simply need to get it leased up first before a bank will take it, or a normal traditional financing will take it. So, this is still a great place for us to be in the sub-$1 million space. The other part is rates are also dependent on geographical area. This is another positive for us. What we've seen is, and we saw this from the beginning, so nothing's changed here around gateway cities. Everybody wants to pile into gateway cities, whether it's Seattle, San Francisco, Los Angeles, yet those are the ones where we've seen higher risks now over with the pandemic, and those are coming back, and we always thought they'd come back. Yet at the same time, because of the amount of players in those spaces, yep, that's where the competition or the rates are. Chris and I feel very, very comfortable with secondary and tertiary markets. I think part of it is just the fact that both of us grew up in a tertiary market. So we were very familiar with the dynamics of those markets. And although though they may not have those incredible growth rates or the sexiness of a gateway market, they're steady. And we make sure of that. When we look at certain markets, we look at those economic factors. We make sure that there's multiple anchor employers, or something like a college or a university, or it's a county seat, or any number of those things where that gives that area, that economic area, that solidity, that we feel good that you have at least steady, if not slowly improving types of economics in that area. But because of that, we're able, again, to get better rates out of those, for us as investors, of course, to get higher rates out of those, because they just simply not a lot of other lenders who are willing to look outside your major metropolitan areas. The last point, prepaid interest. So we've had this really nice run of prepaid interest where we've gotten 6 months of prepaid interest. So in other words, we when we fund a loan, it might be at 70%, but by the time you key in that prepaid interest of 6 months, our actual LTV has been more closer to 5% below that. And that's been nice from a risk standpoint, nice from really just, assuring that we get those upfront payments. However, we always knew that probably wouldn't last. Now I'm starting to have to quote, particularly on multifamily, now closer to 3 months. And I imagine by the end of the summer, we're probably going to see where we're not going to be able to quote any 3 months maybe, but certainly not the 6 months of prepaid interest that we have seen in the past. Now, at the same time, as we see other risk factors that we had to kind of consider during the coronavirus period, which is the inability to deal with tenants who aren't paying, or other issues like that, those risk areas are starting to lighten up, so they're not such a big deal. So the fact that we're not able to really get that prepaid interest, we see those factors balancing out in risk, if that makes sense.
Yeah, exactly. I mean, that prepaid interest was really something that we put in play dynamically as we saw eviction moratoriums and rent questions come up. So, I mean, it's okay that teeter-totters out. That is, as we see that mitigated, where we're not worried about eviction moratoriums and people, higher propensity of people not paying their rents, that's expected that would eventually drift away. But we'll try to maintain that as long as we can, because as Brock and I are large investors in this fund as well. We love the idea of de-risking, the first 6 months of interest payments, knowing that we get a look at that loan. So we'll try to maintain that as long as possible. But let's dive into a little bit of the metrics around the fund and some of the instances we're looking at. Now, a lot of this you guys have seen in our monthly updates. We just want to kind of walk through and reiterate some of this. At the end of the year, the gross yield on the portfolio was 11.56%. When we took the snapshot at the end of March, it was 9.8. If you saw the monthly newsletter, it was talking about cash drag. We had raised money, and what had occurred, a massive slowdown in availability of deals occurred in November and December. That bled into what we were seeing. And Brock will talk a little bit about this later on, because we were seeing lots of deals in the millions of dollars, but it just wasn't something we wanted to put into the portfolio, because, as I know I've told all of you multiple times, for us, it's really more about a risk first and then return later. We're very, very careful about what we're trying to put in the portfolio. So gross yield was at 9.8. We've got a couple loans that we just did. We got one done in April, so we'll see that gross yield certainly tick back up as we get an increased capital utilization. Average LTVs still, sub 70. We think that that's going to be something we're going to be able to maintain throughout the rest of this year. One thing that might change that is, some of the multifamilies come in. If we just have a really low-hanging fruit deal where there's an issue with a bank who can't get a purchase done in time, and we've got a solid multifamily property that doesn't have much of vacancy issues, we might go up to 80 LTV on some of that. Brock will talk a little bit more about some of the things he's seeing in the pipeline. So we might see that later on this year, especially if we don't have a resurgence of COVID. And the weighted average maturity of the portfolio. We've had a solid portfolio that's performed well. And so naturally we're looking at that ticking down. And as that money rotates, you'll see that average maturity start to increase. But we estimate that it'll always be somewhere, right around that 9 month, which is what we've targeted for the portfolio. Now, a lot of you know about correlation. It's something that's near and dear to my heart, because throughout most of my career in investments, having put together portfolios of a number of different traditional and esoteric assets, it was always of interest to understand, if I was going to add something to my portfolio, what was the real impact from a risk standpoint, not so much a return. And one of the best things to look at is, okay, let's talk about some correlations with some cross assets. So what I've done is I've gone in and I've grabbed a couple indices where, hey, we're comparing ourselves against the most common broad corporate, government related aggregate bond index, which I think pretty much everyone uses as a benchmark for fixed income. You can kind of see that, I'm not going to go into some of the other correlations cross index. If someone has a question on that, we can kind of dive back into that later. We'll just talk about the fund here. A negative 0.57. What that really means is, in general movements for the last 12 months, we have seen that whatever move, positive or negative, in 1 percentage point moves of the aggregate bond index, we've seen an opposite move. And now they're tracking a much more volatile asset. We are not that volatile. So we pick up a lot of negative correlation, especially last year when you saw fixed income just, being hammered. Rates were falling. Obviously, it's a reverse relationship. If, interest rates were falling, you're going up. And then all of a sudden now there was fear of inflation, interest rates coming back down. So the aggregate bond index from a principal standpoint was falling considerably, yet we didn't have any negative impact from that perceived inflation fears. So that created and maintains a pretty strong negative correlation. As expected, we have a negative correlation with the equity market, also another very volatile index. You're looking at something that usually carries a 15 to 17% annual volatility. The nature of our portfolio is never going to be that volatile. So it's not surprising to see a negative correlation to a broad, more tech-focused, S&P 500 index. And then the highest correlated index, which expects we'd see a lower negative correlation, is to the MSCI US REIT. Now, that also covers a lot of the commercial space, has some residential in there. But most of that commercial is the mega-sized commercial, the 100 million, 200 million, billion-dollar projects. And you can generally see that, those in this time period have had greater volatility as well. And we just haven't experienced that on the small end. So if there's any questions about correlation or how we're constantly monitoring the portfolio to make sure that we're a good fit against the other assets you may be holding, never hesitate to, reach out, give me a call. I'll probably talk your ear out of that, because I love the risk aspects of putting a portfolio together. But
and yeah, Brock, for those of you on the live, I was just saying, for those of you on the live call here, go ahead and if you got a question during any of these slides, just pop it in. You don't need to necessarily wait to the end to ask us any questions. Just pop it into the chat there. What do you expect, Chris, to happen to some of these, particularly the negative correlations, as our Kirkland Income Fund grows and links? So now we're coming up on a year with March. We are a year. As we start to run into 1.5 to 2 years, what do you expect to happen there with those correlations?
Yeah, I generally feel that we'll have a smoothing out. We'll still be negatively correlated over an extended period of time. The one thing that you can kind of expect is gap events and large volatility continues to occur more often than it should. You can talk to any expert and they're like, left tail events are not supposed to happen that often, but they happen more and more often. So that aspect's going to keep us pretty entrenched in the negative correlated side. But I think we won't maintain maybe these really heavy negatives, but time will generally smooth out those numbers, but we'll still be an asset that's going to be negatively correlated with most people's broad portfolios. Diving in here again, you guys have probably seen this before. We just want to bring it up because here we are on our 12 months of numbers. We came in at 8.53%. We had always sort of set our range at 8.5 to 9.5. Me personally, I would have loved to have been on the other end of that spectrum. I'm not too worried about it. One of the key things I want to bring to light to most people is you can sort of look at the front end of this curve of when we started this fund. March may be what everybody marks the beginning of the problems, but at least in our industry, there was still a lot of chatter and movement in March. But the real pain and suffering for a lot of people became very evident that this was not a fad event that was going to be a flash in the pan. This was something that was going to be ongoing, and that really started to set in April, May, and June. Deal flow, disappeared pretty much. It was dwindling in April and May, and June was a pretty tough month. There was times where you'd call out and there was nothing, nobody doing anything. And I think that was sort of the heaviest shock of COVID was really in June, at least from our standpoint. And as you can see, those rates were below average for what we've been able to continue as we sort of came out of that and we saw deal flow come back in. So we expect, if we can maintain solid capital utilization, you're going to see, rates still in the 70s and 80s net per month. And so you'll get a general tick up on a rolling T12 basis that'll be north of 8.53%, but right in line with where we said we'd be. And given the environment, I'll take a net 8.53% return. That's I'm not too upset about.
I think the other thing I'll mention too here is just, during those early 2020 months where we had just started the fund, we really didn't have the network of loan brokers that we do now. We were just beginning, so we were really constrained around having that wide network. That network has since grown to hundreds of loan brokers that get our information, that know we're out there, and as we put more loans down, in the sense of having done them, our reputation grows that we're someone out there for these loan brokers that we're reliable, that we get things done, and we do what we say we're going to do. Those are important points because, particularly with the way loan brokers work, and maybe
hey,
I'm
Brock.
Yeah.
Brock, someone was saying that they couldn't hear you.
Are you able to hear me now?
I can hear you fine.
Okay.
I just want to make sure that everyone else, can everyone else hear Brock?
Hello? Okay.
Nope, they can hear now. Perfect.
Okay. All right.
You got all the fancy technology. See, you made it super fancy and now it doesn't work.
Yeah, I know. That's the challenge. All right. Getting back to where I was here. So yeah, we just didn't have that network of loan brokers. And there's one thing: loan brokers survive off getting something closed because that's the only way they get paid is that commission when they close. So there's some of them that are hesitant to send it to a new lender who has not been proven. That's quickly dissipating as we close more and more loans. That concern from the loan brokers, of course, is now dissipating, particularly because there's just hardly really anybody out there that will do these kind of loans that we're doing in that sub-$1 million space. So I think going forward, even though we've had sort of a dry period in the first couple of months here, which we weren't able to close anything, we didn't like anything that we saw come across from January until last month. But at the same time, I don't think because of the amount of network we're continuing to build, we'll see the kind of low stuff like we've seen in the past here. So that's kind of all I'll say on that performance. It's really just early teething pains of building that network out.
Yeah, definitely. You're just not quite known yet, but now it's after 12 months, we're getting that reputation of what we're doing and what we're going to be doing consistently, so people know where to go.
Right. So let me talk through our current portfolio of loans that we have, and just kind of hit the highlights of each one. San Antonio, Texas. I got them not necessarily in the order that we've done them. Chicago was actually first, but San Antonio was a super interesting deal. And the funny thing is, when we look at these deals, not only do Chris and I first think, okay, look, if things go badly with this, is this an asset that we want to own ourselves personally? Would I buy this personally if I was presented with this offer? And unless the answer is yes, then we don't want to make a loan on it, because the possibility that we could own this is very real. I mean, it's not really an if, it's a when. And we have these contingencies in place. We've thought deeply about them. We've consulted with the lawyers. We understand what it takes if something goes wrong and we need to take an asset and turn it around. And that's why we feel very confident also in telling you again and again that we have a lower risk portfolio, and we feel quite confident that if we have to take an asset, that we're able to get everything back. Now, back to the San Antonio deal. This was a 16-room boarding house that's near the core of downtown San Antonio in an up-and-coming area. And the owner or the buyer wanted to take this and then turn it from the boarding house that it was into 1 bedroom, 1 bath, and in the case of one other, and then 1 2-bedroom, 1 bath, into 10 units totally. Which is a great change, because you're going from something where it's just a boarding house, shared bathrooms, it just doesn't have a really high amount of people that want this, into something that a lot of people want, particularly in that area. It's great for singles. And the amazing thing about this is he took something here where he bought it for, I believe, around $600. I can't remember the purchase price at this point, but he was looking at finished leasing in 1 year, and it's going very well. The foundation work has been completed. I've seen a bunch of pictures of it. The work is now starting on the rebuild. It's basically a down to the studs redo of the interior, and he's going to end up with an asset that's over 1.2 million, which is pretty amazing that you see that kind of ROI within 1 year. And then when he does the loan in a few months to do a takeout, and once this is done and he's leased up from us and traditional financing, I mean, his cash on cash returns are going to be north of 40% a year. It's just amazing. And we love to see that, because that really justifies, if you've got a question in your mind, like, how in the world can you get these real estate buyers, these investors that are buying these properties or refining, to pay the rates that we're asking, the 11s, the 12s? It's because they're looking at these outsized returns. And so in the end, the fact that they're paying 12% to us on this loan, but they're making 40% on their money, you see where that comes in. And that's what we want to see. If someone comes back to us and says, oh, look, I can't do this loan because I need you to be 9 or 8, and then I'll make it work, and they got no competition, then really we want to say no, because that means they don't have enough meat on the bone, and they're running things so thin as far as their margins go, that there's a good chance that they're going to fall on their face with it. What we want to see is those nice, meaty deals where they're getting a huge ROI on these, and they're out there. And that's what we like to see from our borrowers. Chicago is going to exit at the end of this month. They're just going through the end of the closing for that. That one was some light rehab and lease up of that one. And then Huntsville is a set of 6 units in total, where he's done some renovations. He's had some problems getting people to work on the place, because this is what I mentioned earlier. Getting contractors out there to get work done is sometimes like pulling teeth. It's been really difficult across the board. Now, on the other hand, he's seeing higher than expected rents, and we're seeing this mainly across the board with almost all the cities that we're in. That what we expected, and we try to be very conservative when we underwrite and saying, okay, what out there right now can these people expect as rents, and we try to build that into our pro forma to make sure that there's enough meat on the bone, again, particularly for that exit loan. But and across the board, we're seeing much higher rents, because these are all these secondary, tertiary towns that people are moving to and wanting to be in post-pandemic. Now, what does concern us on this is the borrower is late on the property tax payments. And part of it is just from his standpoint, or his story at least, is that he had a sale of another property that didn't go through right away. That's supposed to be done by the end of the month, and he's supposed to pay those taxes. Now, that doesn't really concern us too much as far as a risk standpoint, because what happens here is that if he can't pay the taxes by the end of the month, we'll step in, we'll pay the taxes. That immediately we move him to an 18% that he's going to be owing on that rate. I don't think he wants to lose all the money he's put in there, and in the end, we'll get our money. So again, this is one of those things where these things happen. We're not worried about it. We've got contingencies in place. Our loan docs, our legal is all in place to take care of this. In the end, we as the fund are going to end up actually benefiting from that, because the borrower wasn't able to really arrange things how they should have. Chris, any questions on that one?
No,
you think I covered that one?
Yeah, no, you covered that pretty good. I mean, that's okay. The only one that really had a little bit of a twinge to it.
Yeah. And then McDonough, this is going well. Again, this was another. I have a bunch of pictures out there too. We want to probably push out on social media, or maybe I'll throw them into one of our updates. But this was a really cool complex that's just within walking distance of the city center of Old McDonough, which is not too far from Atlanta. It's like a little sleeper city, and it was one of those kind of places where it was run down, Class C minus probably. And what they're doing is that they're really turning it into this very cool Class B, even borderline Class A type of classic apartment complex. It's basically a down to the studs renovation, new cabinets, doors, repaint, everything. I mean, it's one of those places where you go and, man, that's a cool place to live. They're also expecting much higher rents as well. That picture was something that the borrower sent last month, along with some other pictures with just the repaint and the new doors and stuff that were going on there. So just some cool stuff. This also goes back to what we've talked about as well, is that we're super happy because we're really providing that middle market housing that you take someone who's a family or a single who wants to live in a decent place, Class B, can't afford some fancy Class A place, doesn't want to live in a rundown rat trap, and really they want to live in these kind of middle market places. And these are really the places where we're funding, where they end up. It's a place in a safe neighborhood where you would feel comfortable living with your family. All right, and then moving on. So the next one here is St. Joseph, was something that we closed in October, and this is I think it was a 24 unit. Now they've just are starting in on some of the renovations because Missouri, it gets pretty cold in the winter, and they couldn't find anybody to do the work on it. Not a big concern to us, but now they're starting in earnest on this. We like this borrower and the fact that they own a lot of assets actually in St. Joseph. They know the area very well. There's a university that's very close, so there's a lot of potential renters available to go rent these places up as they fix them. But in all, again, some place where they're going to do very, very well at the end of this, holding an asset where they've gone in and fixed it up, and once they turn this to traditional financing. Branson, one vacant unit right now. They're going through the architectural renovation plans, and they're starting in on that. So the history here is that this was obviously a motel that about 2 years ago they turned into workforce housing, where they'll rent it out for usually a year at a time, but even a month to month. But most of these are year leases that with people to provide key workforce housing that was really missing in this important area of Branson. If you're not familiar with Branson, it is a town where Dolly Parton has her theme park. There's a ton of theaters where they do live theater. This is one of those places that did suffer quite a bit during the coronavirus, but one of those places also that comes back very, very quickly as people want to get out, want to start traveling, and this is going to be a place that a lot of people in America can actually drive to and enjoy. But the problem with most of these kind of resort towns is that housing is very, very expensive. So the city was very happy that the motel was providing this long-term long-term housing, workforce housing in here. And so they didn't really have an issue with it. But because of their not being under the proper use, of course, then the borrowers weren't able to get normal bank financing. So they're now going in and doing the code changes, which is sprinkler system. They're doing kitchenette updates, bathroom updates, etc., so that then they can change the use permit to multifamily long-term use, at which time then they were able to get us out of this. They're also putting on solar as well. So some neat projects there that they're going to really increase the ROI and then be able to take us out, our bridge loan, hard money loan out with long-term financing. So that's our current portfolio. There's one more I'm going to talk about in a moment that's coming into the portfolio that we funded today. But any questions on these current portfolio deals that we have? All right, Chris.
Right. Yeah, not seeing. I think we dive into some pipeline stuff.
Yeah. All right, so yeah, let's talk about the pipeline here. So the first loan there, and I'm not going to necessarily talk about each loan, but let me hit a couple things here on this. And then this is not everything. This was updated like literally 2 days ago, and there's already like I think another 3 or 4 loans that came in over both Wednesday. What is today? Thursday. Tuesday night there was a loan that came in, and then that's not on here, and there's a couple more that came in yesterday, and I think another one today. So we've really seen a huge uptick in the amount of pipeline deals coming through the pipeline here. These are not every deal. These are simply the deals where we all have put out what we call a scenario proposal, where we like what we see so far, and we just kind of put together like, hey, here's what we think we'll be at on rate. Here's what we'd be on an LTV. Here's what we'd be on points. And then we get that out to the broker for them to talk with the client and see whether they want to move forward or not. What's not on here is for every one of these, there's another 10 deals that come across our desk that we just say, nope, not in our wheelhouse. Nope, we're not interested. So you can imagine the amount of stuff.
No lack of shady deals.
Yeah. Well, or, and maybe they're a legit deal. I will tell you that where we probably turn down a lot of deals is deals that are based on ARV. So ARV is what a proposed value based on what so you've got an as is current value of the place, and then ARV is a value that supposedly will be there once they've done the renovations.
Mhm.
In the fix and flip world, this is the main thing that fix and flip lenders go off of. They'll take a deal and they'll fund 100% of the as-is value, as well as some of the extra construction costs based on that ARV. But that's not what we do. Those are much higher risk. I'm not saying anything's wrong with those, but those are higher risk deals. What we've stuck with is as is current value, and that's all we go off. But that means that we don't look at those that deals that require ARV, because that means that the borrower is putting much less skin in the game. They're not having to actually cough up sometimes the construction costs or the renovation costs. So it's just not, when Chris and I decided to build a very the lower risk type of fund where we didn't want to ever lose the money, we felt like we better go with as is value, because if something goes wrong, we can always take it out and we know we're going to get our money back on it. So anyway, that's one thing where we don't get those deals. We turn those down where they need an ARV based deal. The first one is Pontiac, Michigan. This is a medical complex right across the street from a hospital. I tell you, today as we closed it, the broker told me that the leasing manager from the commercial real estate firm that's handling the leasing for this thinks that he has the whole third floor rented out, which basically soaks up most of the vacancy for that building. As I was joking with him today, I said that the borrower, Mr. Khan, honestly, owning a medical building across from a hospital, it's really just a license to print money. And so I think he's going to do very, very well on this. The most of this money that we gave cash out, there was actually no current lien against it on this building. He had actually got this out of a settlement for a business deal gone bad with a previous partner, and he was awarded this medical complex. I think he came incredibly much better than if he had just gotten cash out of this. But because of that, we did a cash out refi. That most of that $600,000 is going to go into renovations for that building, as well as some cash cushion for just running operations for that building. But we really like this deal. Then there's the two next that are in underwriting. Both of those have term sheets that have been signed. One we're waiting on payment. The Bradley one unit is a glass shop, low LTV, long-term borrower, or the borrowers. I think of steady. They've owned the glass shop. It's a third generation glass shop now. Yeah. for the area. This is just south of Chicago. Strong area. This is one of those deals where the reason they can't get bank financing yet, the guy and his mom went, I think it was the mom, went through some cancer issues. And so, that soaked up a whole bunch of stuff when you're, how do I say, you're a business owner and you don't have the great insurance coverage. They got into some credit issues about 2 years ago, paying those medical bills. They've since cleaned all that up, but because their credit's not perfect, bank didn't want to take them yet. They need about another year out there on this. So we went in there. We felt quite good at a 65%, a little under 65% LTV. The fact that they've caught themselves back up and they're actually in a pretty good cash position, but they want to take out a loan where that was really just eating away at them. And then the Shelbyville, this one is where they need a bit more cash out to finish up a mixed use where they've done around 95% of the work has already been done. They've put in a lot of money already. And so the value at the beginning of 2020 was 680. Now we estimate value probably at 900. The ARV, there's that ARV. We still look at that because we get a kind of sense where they're going to come out at the end. Particularly, we want to see that they're going to come out really nicely in the end, making a lot of money. It is probably in the 1.2 to 1.3 million when this is done. The rest of what we're seeing just a mix of industrial cannabis stuff. We haven't closed on any cannabis stuff, but we're willing to do so. We get some higher rates there, and we have to do a little bit more due diligence on those. And then just the rest are mixed use. The retail, we are okay with it, but we make sure that we stay low on the LTVs, or we take a look at like the fast food, a single fast food. A lot of it has to do with location. Fast food has continued to do well. during the pandemic. So we continue to expect that to do well. And then, of course, we always love multifamily. That's kind of our bread and butter. Chris, any questions here?
No, I think, I mean, one of the comments is it was really interesting. We did see a slowdown, at the beginning of this year from a deal flow standpoint, but it wasn't just us. We were seeing a lot of people come in, and a lot of people making the same comments around multifamily. And we experienced that too, where we were like, what's really happening to the pure multifamily trades? And, just in the last few weeks, we've started to see those come back. So there's more people out there looking to get those purchases in there. So we expect to see, more of those coming our way.
I think one of the reasons that, in talking to people around why perhaps multifamily and some of the other asset classes slowed down is that, about in July, August, there was this irrational, well, maybe it wasn't irrational, but there was this exuberance around, and we saw these huge funds being put together to pick up distressed assets. Oh, it's going to be great. It's going to be '08 all over again. We're going to just mop it up. And so there began, starting August or so, to be this huge disconnect, this schism between what, particularly multifamily and even industrial, what the asking prices were for these versus what people were willing to pay. Because what was happening is everybody thought, well, I'm going to go out there and mop it up with low asset prices, and they were looking for the deals. Where can I get a deal? Where can I get these depressed asset prices on multifamily, et cetera? Except they never appeared.
Yeah, it only appeared in hospitality, and that's not what they wanted.
That's it. Yeah, that's it. You wanted to pick up a mall at a discount, you could do that. You wanted to pick up some retail at a discount, you could do that. But even that was limited. Just didn't happen. And so I think that really drove things probably until January, February, where finally, now that with the vaccines out there and the light at the end of the tunnel, you saw buyers realize those deals, those discounted deals weren't going to appear. And they certainly, with the way things are going with the economy now and the vaccine, are not going to appear. So they kind of readjusted things and realized, well, if I wait on the sidelines, I'm just not going to get anything. And so they've started to re-enter, and that's why we've seen this huge pickup, this huge uptick in deals now again.
Exactly.
All right.
We can talk some operations and fund structure.
There we go. Chris, you want to take that one up?
Yeah, definitely. As all of you should already have, the administrator should have sent out audited financials. If you have not received those, please do let me know. We'll get those out to you ASAP, so you have the record. It's something that we want to make sure in our efforts of full transparency that all of our investors, get to see under the hood and over our shoulders whenever you need to. K1s were completed and sent out. You should also have those. We did not receive any comments back if there was any problems or something missing, so I assume everyone is in good order on that. Everything went very, very smoothly, so we were very happy with, and I have to give a shout out to, I know you guys don't really see her much, but she's there, is Tashi Schmidt, our CFO, is immensely helpful on so many different things with, operations and finance and making sure that, things are ready to go when they're needed. Let's talk a little bit on the custodial program. A lot of people know that last November, we were approved by Charles Schwab. We recently got approved and moved forward with TD Ameritrade. Some of that help. As much as Schwab bought TD Ameritrade, they're still very, very separate entities. They do their jobs very differently, but we are on TD Ameritrade. There's a few other groups we're talking to. Those have been, slow to progress. A lot of demand for these custodial platforms actually comes from investors. So it's somebody who works on a particular specialized alternative investment platform. You're the one that goes and sort of says, hey guys, I'd like to have this fund have access to this because I want to basically leave my money with whoever it may be, say Charles Schwab, and then they help move that process forward and get us approved. We haven't had, once we're on the docket to be approved, we've had absolutely no problems. We've actually been, moved through the process faster than most people, which is for me, I take great pride in that because it basically shows that a lot of the things that we've built and the process and procedures we have meet their requirements for protection of investor dollars, which is the number one thing that the custodial platforms are looking for, which is, obviously very important to us. We did run into some issues with some of the custodial programs. They are large. They're still a little antiquated, and we are trying to be technology forward thinking. And our efforts to automate and enhance process is not always well received with some of these large custodial platforms. But we have worked through with, unfortunately, some investors. You know who you are. We had a lot of back and forth, and we had a lot of problems. But we have worked out a process that where we can actually really drive that process and make that investor journey better for people, so that it's less on your shoulders, more on the custodian and ours, to make sure that that information gets done. So we do apologize for how long some of those have taken, but we think we figured that out, and it won't be as cumbersome going forward. On the operational line of credit, we don't use any leverage. We don't really plan to make that a strategic part of our fund. It was never meant to say, hey, we're going to go get into larger loans that are charging less interest, but I got to be competitive, so I'm going to lever it 1-to-1 or even higher so that I can be competitive with maybe a high single or double digit return that we're able to offer with no leverage. That's not the game we're in. But with that said, one of the things that we have run into, and we have certainly run into more than once since starting this fund, is capital utilization. In this month's newsletter, you saw addressed the issues of cash drag. And that, just for a quick explanation of what that is we raise a series of money. Most likely what we have is we have a loan that is, say, $600,000. We only have $400,000 in the hopper. We have to wait, push that loan out. It ends up extending into next month, where we raise additional capital, and then we're able to service that. What that creates is a lower performance in that previous month. For investors, the way we run our accounting is month to month, and we share everything pro rata, so everyone is able to capitalize on as much diversification as we can offer as we grow this fund. But that will create those dips in return. We are talking to a number of different banks. We have found a couple that are interested in assessing our fund for a potential line of credit, that when we do run into that situation where Brock goes out and finds a loan, we have the money. Maybe we're a little shy on the actual fund. We've got $500,000 for a $600,000 loan. We can go pull $100,000 and really increase that capital utilization for investors, making sure that we're deploying all of our investors' funds as efficiently as possible. And then when new money is raised or a loan comes off or something of that nature, that line can just be paid down. And that's going to be that core functionality. So that is actually progressing, and we're having some good conversations. So you'll definitely hear more on that front as we're in the process. We're in the middle of due diligence with one bank right now that is interested in providing that service to us. So anything else, Brock, on operations?
No, I think you covered it well.
Okay.
Yeah, I mean, I just imagine once we get that and we're able to basically be deployed pretty much 100% of investor funds, that's really going to smooth out those returns and increase them to the maximum that we can in a very lower and much lower risk method.
Yeah, I mean, the nature of deploying a little bit of leverage, it's really funny. Just in my network, talking to a lot of people who are much, much larger than ourselves, doing similar businesses, but you're running, $800 billion funds. They look at the profile of what we do from a lending standpoint, and they love it. They understand that what we do is capacity constrained. We're never going to be their size, but we're able to really control risk and take much less risk. And almost all of them have said at some point, yeah, you don't need to go lever up. That's an operational risk that I don't suggest anybody to do. If you have a trade that requires a lot of leverage, you should rethink your trade. That's been that's worked for a while, but always finds its way to give trouble to investors when you have a gap event. So we're not going to go down that road, but it's something that we could definitely add, say 25 cents, or maybe even up to 50 cents on the portfolio, and really incrementally add almost no risk to the broad portfolio. So it's something that I'll be looking at, and looking to deploy and running the numbers on that, so that like Brock said, really it's about maximizing our capability without really taking a lot of undue risk.
Yep. All right. We'll just open it up for any questions here at the end before we log off here.
Any questions?
All right. I guess we covered it pretty well.
Yeah, I know, and I know a lot of people couldn't make this, so we'll get this out to people. And if there's any questions for Brock or I, feel free to reach out.
Yep. All right. Thank you for attending. And again, just give us a contact if you ever got any questions in the future. Thank you.
Thank you.